If you have been looking to scale your real estate portfolio into multifamily properties, like a 5-unit multiplex or a 10-unit apartment building, you already know the biggest roadblock: capital, money. Traditionally, commercial lenders want you to put down 25 to 35% of the purchase price. On a $3 million property, that's up to $1 million cash out of your pocket just for the down payment. But what if I told you that there is a government-backed program that lets you buy a multifamily property with as little as 5% down, amortized over 50 years, and get lower interest rates than conventional commercial loans? It's called CMHC MLI Select. In this video, we are going to break down exactly why government created this program, who actually benefits from it, the core rules you must know, and the exact steps in buying process where you need to apply. Then we are going to run a real math-backed scenario on a 10-plex priced at $3 million to show you how the numbers pencil out. Let's start with why this exists. Canada is in a massive housing supply deficit, and renting has become unaffordable for millions. CMHC, the Canada Mortgage and Housing Corporation, created MLI Select to incentivize developers and investors to build and preserve the kind of housing Canada desperately needs. Instead of just looking at your net worth and the property's cash flow, CMHC rewards you for delivering social outcomes. They do this by point-based system focusing on 3 categories. Number 1, affordability, keeping rents below median market rates. Number 2, climate compatibility, making the buildings highly energy efficient. And number 3, accessibility, making units barrier-free for those with mobility challenges. Borrower financial requirements. CMHC underwrites the property's income rather than just your personal T4 income, but you still must meet strict financial benchmarks. Who does this help? For tenants, it creates high-quality, accessible, and energy-efficient rentals they can actually afford. For you, the investor, it gives you leverage. It lowers your borrowing costs, drastically reduces the cash you need to close. And it protects your downside with limited recourse financing, meaning your personal liability is heavily capped if you hit the 100-point mark. To unlock these terms, you have to play by CMHC point system. You need a minimum of 50 points to qualify for the MLI Select program, but the real magic happens as you score higher. 50 points gets you up to 85% loan to value, LTV, and 40 years amortization. 70 points unlocks up to 95% LTV and 45-year amortization. 100 points, this is the holy grail. It gets you 95% LTV and 50 years amortization, and the deepest discounts on your mortgage insurance premiums. So how do you get these points? You mix and match from the 3 categories. Affordability, you commit to keeping the percentage of your rents below a specific threshold, usually 30% of the median rent income in your local market for at least 10 years. The more affordable units you commit to, the better and more points you get, up to 100 points. Energy efficiency, if you're retrofitting an existing building to be at least 20 to 40% more efficient than the standard condos, you score up to 50 points. For the new construction, the targets are even higher. Accessibility, modifying the buildings to meet universal design or Rick Hansen accessibility standards can land you another 20 to 30 points. Most small to medium investors find the sweet spots by combining affordability and energy efficiency to cross that 100-point line without breaking the bank on elevator installations. Costly. Borrower financial requirements. Debt service coverage ratio, DSCR. The property's net operating income, NOI, must cover the annual mortgage payments by at least 1.1. Net worth. You must have a minimum personal net worth equal to at least 25% of the loan amount, with absolute minimum of being $100,000. Liquidity. You must show liquid assets, cash, stocks, easily accessible savings, equal to at least 10% of the loan amount. Management experience. You must have at least 5 years of documented experience managing multi-unit residential properties, or have a formal contract in place with a professional third-party property management firm that does. One of the costliest mistakes investors make is assuming that they can buy a property and figure out CMHC later. The MLI Select program underwriting process takes time, typically 3 to 6 months from start to finish. Here's the exact sequence you need to follow. Number 1, pre-qualification and underwriting. Before you make an offer, work with a CMHC approved commercial mortgage specialist. You need to model the property's current financials, commission and energy model, and determine exactly how many points your project can realistically score. Number 2, write the offer with finance condition. Do not write an unconditional offer. You need a long finance condition, ideally 60 to 90 days, or be prepared to close using temporary bridge financing while CMHC processes your application. Number 3, submit CMHC underwriting review. Your lender packages the energy reports, rent roll commitments, and appraisal, and finally submits them to CMHC for approval. Number 4, commitment and funding. Closing the deal. CMHC issues a formal commitment letter confirming your points, loan to value, and amortization. Your lender then funds the mortgage at closing. Now, let's run the real numbers. Let's say you found a solid 10-unit apartment building in Ontario priced at $3 million. We are going to target the 100-point tier by committing a mix of energy retrofits and affordable rents. Here's how the conventional path compares to the CMHC MLI Select program. Look at that down payment difference. On a conventional loan, you need $750,000 in cold hard cash just to get the keys to the building. With MLI Select, your down payment is $150,000. That leaves you with $600,000 in liquidity to renovate the units, upgrade the energy systems, or even buy another building. The cash flow check, DSCR. Now, can you actually carry a $2.85 million mortgage on a $3 million building? CMHC requires a minimum debt service ratio, DSCR, of 1.1. This means that the building's net operating income, NOI, must be at least 10% higher than the annual mortgage payments. Because we are stretching the amortization out to 50 years and getting a lower interest rate, the monthly payment on that larger $2.85 million mortgage is actually incredibly manageable. Similar to what a 25-year conventional payment would have been on a much smaller loan. Keep in mind that CMHC updates their fee structure. There are amortization surcharges, so work closely with the experienced mortgage broker to build these costs right into your pro forma upfront. The CMHC MLI Select program is quite a game changer for multifamily investors in Canada. It lets you scale faster, keep your cash, and build a portfolio that actually does good for the community. But remember, do not do this alone. The underwriting is highly technical and you need a solid team, including an energy modeler and an experienced CMHC approved commercial mortgage broker, before you even think about putting pen to the paper on an offer. If you have found this information helpful, hit that like and subscribe button and let me know in the comments below. Would you buy a 10-plex with 5% down, or do you prefer staying in the residential space? See you in the next video.